Hello and welcome back to the House of Trade. I am Justin Banton. Let's do something new today. Instead of reading an article about the topic du jour, I'm going to read the comments and you figure out what I'm talking about. Okay, number one. The greatest engineering feat of artificial general intelligence is the financial engineering itself. Let me do another one. If you build it, they may not come. Here's another one. Imagine all of the unemployed cats this will result in. Why should government finance GPUs making cat videos? Imagine all of the cat videos to come. Even if this is true in theory, that AI will eliminate most jobs, I cannot imagine Peter Thiel, Sam Altman, David Sachs et al. And Donald Trump allowing for income or wealth distribution. And the real AI that you talk about would allow them to ignore governments and popular franchises. Have you guessed yet what I'm talking about? Let me do one more comment. Yes, but not to worry, clever Uncle Huang, I think that's mildly racist by the way, will sell everyone another $1 trillion of processors to replace those that get fried in the 3 years. And he will keep doing the same from now until eternity. At least that is what the valuation of companies seems to imply. And the combination of incessant cheerleader hype and massive circular deals will keep the juggernaut rolling until it reaches the cliff edge. What about after that? So, have you guessed what we are talking about yet? Well, top prizes, round of applause to the person or the people who guessed we are talking about the investor worry over big tech's AI spending and how it's spilling over into credit markets, debt markets, bond markets, and the circular jerk off that is the AI build out infrastructure. But before we do that, let's have a look at a few of these charts that are, quite admittedly, trading at dizzying highs. Apple, which, I mean, they're a huge behemoth of a company, a huge technology player, but I'm not really seeing them in the AI space a lot. I think they're getting like a concomitant or a related bid because these technology companies, the Magnificent Seven, are so high up in pricing. But let's look at one that is more related. Tesla is related, but probably the more important one would be Nvidia. Now, is my chart going to load for Nvidia? Apparently not. We'll come back to the charts. Let's read this article. So, investors have been selling off debt of US tech heavyweights, showing how jitters over Silicon Valley's boom in spending on artificial intelligence have spilled over into the bond market. Does this sound familiar whatsoever? Do you remember, well you might not remember, but when the internet build out was occurring and before the .com bubble, billions, trillions were spent on infrastructure. And on the .com bubble, it all kind of went pants. And there's a lot of companies still actually recouping losses from the build out. It never really ever got to fruition, or it never really achieved what they thought it would achieve then. But obviously now we are living in the bountiful fruitfulness of what they planted back then. The seeds that were sowed then only have come into fruition now. It might be the same as AI, and that's why these valuations are kind of disjointed and disconnected from reality, because we are very much playing towards the puck, where the puck is going. The AI, we didn't really actually know what AI is going to be used for. I mean, at the moment, it's being used for cool things like generating videos of cats or like killing Ukrainian and Russian soldiers with drone warfare, but we don't actually really know where the AI build-up is going to lead us. I don't imagine people knew or imagined or envisaged the internet that we have now when they were doing the $1 trillion build-out for fiber, broadband, and all of the other like modem dial-up stuff that was going on back then with the companies that were touted to be like the next gen things forever, never ever going to leave our ecosystem of markets and assets. But they were traded into oblivion and they went like into Chapter 11 bankruptcy. We never really envisaged where we would get to in terms of like Web 2.0, Web 3.0, crypto rails, ubiquitous social media. No one could have honestly said to you, oh yeah, I think that that's where we're going. But is it the same for AI? It could be. Let's continue reading. So a basket of bonds issued by so-called hyperscalers that's another phrase for this. Companies who buy lots of chips from one another, scale them up, and their chips are going to be redundant and obsolescent in like 3 years' time. Because the tech is moving at such a dizzying pace, and Moore's law is going to make everything so obsolete that the people who are spending trillions now, those AI chips are probably not going to be able to make videos of cats in like 3 years' time. But I digress. Companies that are building vast data centers, including Alphabet, Meta, Microsoft, and Oracle, has sustained a hit in recent weeks. I wonder why. The spread or premium yield investors demand to buy the debt over treasuries has climbed to 0.78 percentage points, the highest level since Donald Trump sent markets reeling in April with his tariff plans. Why do you think those spreads and those premiums are rising? Well, it's because this circle jerk of companies buying chips from one another, Nvidia buying things for OpenAI, OpenAI invested in Intel, Intel buying AMD, AMD invested in TSMC. People are starting to see that this is a house of cards, right? It's circular financing, it's circular funding. So the premium demanded from these debt owners and the issuers is going higher, right, above the risk-free rate, because they're realizing, hey, I mean, if one of these cards collapses, everything in the whole pile will also collapse. The widening spread highlights how investors are increasingly concerned with the way tech groups are turning to debt markets to finance their investments in AI infrastructure. I mean, these guys are spending trillions, right? Mark Zuckerberg is saying, I'm going to spend 140 billion, right? A lot of these companies don't have any revenue. OpenAI is a private company. They don't actually have the money. But people are investing hand over fist in them. I get it. I understand why it has to be distributed. The capital has to be allocated, because in the model of this investment model, you have to kind of pick the winner. And if you don't show that capital allocation, you will get left behind. If you're not invested in the circular jerk, you're definitely not going to receive the orgasmic dividends at the end of it. If you're not in it to win it, there's no skin in the game. You definitely will be left behind. Better to be invested and it blow up and you reap the benefits from it than for you to not be invested and for you not to reap any of the benefits. But I understand the calculus of it. They've got shareholder responsibilities, they've got boards and fiduciaries to report to, and they have to explain why they're invested. And to be honest, it's led a lot strategically and geopolitically, not just by these corporate entities, but also by the oligopolist class and government. I mean, it's a huge interest in terms of national security. So JP Morgan on Monday said building AI infrastructure will cost more than $5 trillion and will likely require participation from every public capital market, as well as private credit, alternative capital providers, and even government involvement. I don't see anything wrong with the government actually getting involved. I feel like state-led capitalism, I think it's called de rigueur, the rigism capitalism, like what we see in China, where the state is heavily involved. They have huge plans, like 5-year, 10-year plans. They direct the economy, they finance certain sectors, and they make national strategic interests like the champions. They're national champions, and that's how China have developed a dominance in EV, in battery tech, in rare earth mining and processing. I don't see anything wrong with that. Where I do see things wrong with it is where public capital markets and public debt markets are involved in this unholy combination where if something goes wrong, it's inevitably going to be me and you or another, sucker of a taxpayer who has to bail these people out indirectly or directly, because the house of cards is so interrelated and so interconnected, right? The mammoth scale of investment in AI infrastructure has raised concerns over capacity, long-term profitability, and energy demand. There's some crazy figure out there that all of crypto mining takes up the same amount of energy as Czechoslovakia and Poland. And all of the cooling required to cool the data centers of tomorrow are going to take up all of the energy requirements of UK and France. Now that's insane if you actually think about how much energy that demands. But if we get on the right side of things, there are a lot of flywheel effects that could increase employment, it could increase tax receipts. But who am I kidding, right? These guys have the best tax accountants and best tax lawyers. That probably mean we're going to end up paying for their AI build out in our pensions in 50 years time. God willing, we live that long. I don't know, the nuclear testing re-emergence from Donald Trump doesn't take us into Armageddon again. But these are huge questions. Long-term profitability. OpenAI aren't going to be making their money from $20 a month subscription models. It's just not going to happen. And the real fear I have, well, not really a fear, but I suppose it's a bone of contention and melancholy and depression, is that all of these ever increasingly smart individuals that go from the pipeline of Yale, of Harvard, of Imperial University, of UCL, of MIT, they all go into this AI or to this finance industry. And what is it designed to do? Not to solve world hunger. Not to address something as mundane as, I don't know, like starvation or inequality or gender issues. No, it's there to sell you more shit. More ads, targeted better, targeted for longer, keep your eyes on screens for longer, and sell you things more efficiently. And that's what these tech giants are really doing. Mixing a bit of digital ID, mixing a little bit of taking away your rights in a stealth mode, and we've got to where we are now. So tech giants are issuing debt at a quick rate to fund their AI expansion efforts, despite having large cash hoards, something some investors worry could signal a shift to higher levels of leverage. The hyperscalers collectively hold about $350 billion in liquid cash and investments and are expected to generate roughly $725 billion of operating flows in 2026. Well, if I'm just doing the simple calculations in my brain, and I'm no Newtonian mathematician, I can see there's a huge disparity between what's being invested and what's being taken out. Now that can't be sustainable forever, boys and girls. Even so, substantial new debt supply is coming to the credit markets from these high quality issuers. In recent weeks, Meta, Alphabet, and Oracle have hit markets with blockbuster debt packages, some with maturities as long as 40 years. So let me get this straight. In the future, in a basket of securities bought by your local pension fund right near you, you might have 40-year paper for Oracle and Alphabet with nothing of this long-term profitability or scalability or operationality actually proven out. It's scary. If it goes wrong, it's scary. It's scary. But nevertheless, I think the Federal Reserve have your back. The central banks around the world have your back. And they're going to print, baby, print. So it doesn't really matter. I'm sure you'll be bailed out either overtly, covertly, directly, or indirectly, right? Meta last month forged a $27 billion private deal with investors including PIMCO and Blue Owl Capital to fund the development of its Hyperon data center in Louisiana. It raised an additional $30 billion in bonds at the end of October, the biggest corporate bond deal since 2023. Where's all this money coming from? That's what I want to know. The cost of capital isn't cheap anymore. We're way past the areas of ZERP, and these people aren't raising money at like pitiful penances of a rate. Where's the money coming from? Who's allocating this capital? And what are their long-term obligations and the debt covenants that go along with this? Like, what are the contracts? How are they baked in? Or is everyone just throwing money after something and hoping it sticks? I fear it probably is the latter, to be honest. So, Alphabet, they've sold 25 billions of bonds. Oracle sold 18 billions of bonds only in September to fund their infrastructure leases and to help with Stargate. Oracle has about $96 billion of long-term debt, according to Bloomberg data. It has rapidly grown its debt balances as part of a series of deals to lease computing power to ChatGPT maker OpenAI, which the software group has said would generate $300 billion in revenue over the next 5 years. Well, I mean, I could probably issue these as well, right? I could issue these halcyonic and these propitious forecasts as well. But what there is related to this and linked to this is another thing to consider. I was reading an article the other day with new rating agencies. These new rating agencies who are basically underwriting all of these new bonds. And some of them, I mean, you've never heard of them. It's not the Moody's, right? It's not the S&Ps. It's not the Fitch. I mean, those guys aren't exactly salubrious either. They've got their hands in the cookie jar as well. But let's read a little bit about this. 17 years after credit rating agencies' starring role in the financial crisis, rating shopping is in focus again. So these companies, they're issuing all this debt, no doubt. I mean, they're blue chip companies, Meta, Oracle, Facebook. I mean, all of these companies, they do their thing. They generate revenue. They're profitable. They're all profitable companies. There's nothing like shaky or foundationally unsound for now. But if in the future the AI doesn't return in spades what they are forecasting now, we could go back to seeing things like these, rating shopping being in focus again, come into play. Hey, how did that Oracle paper for 40 years get signed up as AAA? I don't know. Maybe let's read about this article now. The first time around, large established agencies competed for grade a finite pool of debt, gave out inflated stamps of approval to risky assets. Buyers of the assets were falsely left with the impression that the subprime credit they were holding was as safe as it got. Well, similarly, some of the world's biggest asset managers, including Blackstone and Apollo, are now among the most frequent users of ratings from firms beyond the big three. And where do you think most of this paper from Oracle, Meta, Nvidia is going? It's going to BlackRock, it's going to these huge companies here, and they are using these rating agencies that no one has ever heard of. Specialist providers like Morningstar, Crowban Rating Agency, HR Ratings, Egan-Jones. They've seized market share by offering private capital groups the chance to shop around. I mean, what could go wrong? A lot could go wrong. But it is something to definitely keep your eye on. And again, let's play the game of the comments, because sometimes a lot can be gleaned from the comments. Deja vu all over again. When will people learn? Clearly, evidently, never. They won't. Not to worry. All is very, very normal after all. Skin in the game. If profits go to one side but the risk to the other side, there's a problem that won't go away. So I'm guessing stricter rules on how to rate, or more public disclosure on financial data, or the risk part of it. Accounting rules are also something that might help. Yeah, you think so, right? It might help. Sadly, no rating agency fraudsters went to jail last time. Hopefully this time is different. Well, I doubt it very much, boys and girls. Now, we've spoken about the AI doubts and the worries, and I mean, that is actually being reflected in markets at the moment. My feed isn't working, but if we actually look at a lot of these companies, the AI dream is kind of dying in front of us in some ways, but I mean, there also are very, very high hopes for it as well. But I'm going to leave it there. Please tell me what you think about the rating agencies, what you think about the AI build out, whether you think the long-term profitability and the prospects are as auspicious and prosperous as everyone hopes they will be. Yeah, share, like and subscribe, and I'll see you on the next one, guys. Ciao for now.